Hello everyone, this is Dr. Zhao from MTSU. Let's go through the chapter 18, Portfolio Performance Evaluation. So this chapter is all about how professional money manager evaluate their portfolio performance. Let's say manager A. He did pretty well, returned 5 million US dollar for his clients. And the question here is, will the clients be happy with his performance or not? You might say, yeah, of course, he made 5 million US dollars. That's a lot of money. But here, you need to be careful. This money manager could be fired. What? 5 million US dollars again? He will be fired? Why is that? I mean, that's unbelievable, right? But once we go through the major content for this portfolio performance evaluation, then you will understand why this manager may be fired. Now, let's take a look at how a professionals actually do their performance evaluation. And the evaluation here doesn't just about evaluate how return satisfy their clients' needs, and actually it is the risk-return trade-off that matters most during this performance evaluation process. And the performance evaluation method varies dramatically. It depends on the investment style of the fund. And here we have two very different style of investments. One is passive, the other one is active. And for passive portfolio management, when they need to evaluate the performance, they probably won't need to take a look at how high the return is, because the goal for passive management is to track the market index as close as possible. But for active management, it's totally different. And the goal for the active management is to beat the market benchmark. So here, manager need to look at the actual return and the benchmark return. And if their actual return is higher than the benchmark return, in that case, you would say, hey, they beat the market. That's great. But here, return is not everything, and we need to consider the trade-off between risk and return, right? And there are a lot of details in terms of how to evaluate the true performance regarding the risk-return trade-off in this chapter. This picture shows you how to do comparative evaluation. At any given point, a portfolio manager wanted to evaluate his or her performance relative to certain benchmark. That benchmark could be the market average, and also that benchmark could be competitors, other money managers. And this picture showed you, okay, the evaluation process considers both market benchmark as well as their peers. For example, in this example, we have money manager Markowell Group, and their performance is represented by the black dot, and the blue dot here is S&P 500 return. So here you see during the first quarter, this group beat the S&P 500, and also you see their performance is close to 75 percentile of the entire money manager universe. I mean, all the money managers managing other clients' assets in the United States. And during the last year, you look at a 1 year benchmark here. 1 year benchmark S&P 500 is higher than Markowell's group's performance. And here you see 1 year performance for this group is not pretty, because they underperform the market, and also relative to their peers, they're around 25 percentile. So this picture showed you that money manager needed to measure their return not only relative to the market average, but also to their peers. As I said, the performance evaluation is not all about the returns, and it's more important to focus on risk-return trade-off. And here, you see a very basic approach we can utilize to look at so-called risk-adjusted performance. So that return need to be considered along with the risk beared in a certain portfolio. And the single index model showed you that return for the portfolio is a function of market risk that a portfolio has. And also certain portfolio may generate alpha, which is the excess return, as well as the error return, that is the firm's specific risk involved in their portfolio. If portfolio is well diversified, that error return should be equal to 0. So what's left here is beta p times market return plus alpha. So beta p times market return is required rate of return that the manager need to deliver based on the risk that they bear. And this alpha is the excess return. That is the true performance that manager delivers to their clients. There are many different methods that manager can utilize to evaluate right now is risk-return trade-off for the portfolio during certain time period. And let's say we have two different portfolio, P and Q, and also we can compare those two portfolios performance with benchmark. And on this table, you see there are a total of 11 measure of risk return trade-off. The first one is average return. Portfolio P delivered 13.6% average return, and this number is pretty good because it beats both portfolio Q and benchmark around 10%. So simply based on return, you would say P did a really good job, but is that the truth? Maybe yes, maybe no. And we can only find the truth after we examine the risk that the portfolio P has. And second, in the second row, you see average excess return. Average excess return is excess return above risk-free rate. And here we assume that risk-free rate is 4%. So once again, you see portfolio P delivers the highest amount of average excess return, higher than portfolio Q, as well as the benchmark. Now, it's time for us to look at the riskiness of those portfolios. And the portfolio P here has 24% of standard deviation, compared to 18% for portfolio Q and 18.5% for the benchmark. So what you see here is, although portfolio P delivers the highest amount of return, but it also carries highest amount of risk measured by standard deviation. And this standard deviation contains both market risk and firm specific risk. So assuming that portfolio is well diversified, then what investor need to pay attention to is the market risk, which can be captured by the beta. And here you see beta for portfolio P is 1.25, which is much higher than the beta for portfolio Q. And the market itself has a beta of 1. Now, this alpha in terms of percentage is a very pretty measure for risk-return trade-off. And alpha equals actual return minus expected return based on the beta of the portfolio. And consider the risk, tremendous amount of risk that the portfolio P bears. We found that excess return, or alpha, is only 1.6% versus 2.3% for portfolio Q. So in terms of overall performance evaluation, if we use alpha as the measurement, then we can say that although P delivers absolutely higher rate of return, but considering the risk that this portfolio bears, this alpha showed that the portfolio Q actually did a better job than portfolio P, because portfolio Q delivers higher amount of alpha, 2.3%. So based on alpha, we can say that Q did a better job than P. Residual standard deviation measures error terms for both P and Q, and actually you see Q has 15.44 and 6.79 for portfolio P. So this residual standard deviation measures firm specific risk, and the higher the number, the more unsystematic risk embedded in that portfolio. And in this case, we see that portfolio Q has higher amount of unsystematic risk than portfolio P, indicating that the portfolio Q is less well diversified than portfolio P. And also we can look at a correlation with the benchmark. And the P is closely related to the benchmark, while Q is less correlated with the benchmark. With the correlation of benchmark 0.5 versus 0.96 for portfolio P. Now, we have another measure of risk-return trade-off, that is Sharpe ratio. What is Sharpe ratio? Sharpe ratio equals excess return divided by standard deviation, right? And here, Sharpe ratio for P is 0.39, and the portfolio Q has 0.3 Sharpe ratio. Which one's better? I would say P is better in terms of Sharpe ratio. Right? And the Sharpe ratio is another measure of risk-return trade-off, but you should pay attention to what's in the Sharpe ratio. What's in the Sharpe ratio is standard deviation and the measure of risk. Right? If portfolio is well diversified, then alpha would be better measure of risk-return trade-off than Sharpe ratio, because Sharpe ratio contains unsystematic risk. M square. M square is another measure of risk-return trade-off, and P has a 1% M square, and Q has negative 0.72% of M square. Excuse me. And here, higher M square indicating that portfolio does better than the benchmark based on the total risk contained in the portfolio. And we have more. Trend measure 7.68 for portfolio P and 11 for Q. What does that mean? Higher trend measure means better risk-return trade-off. In that case, Q beats P. And also the last one, information ratio, shows the ratio of excess return, or alpha, versus the unsystematic risk beared in the portfolio. Right. So here, Q delivers higher amount of alpha, but sometimes the reason why portfolio manager can generate alpha is because they bear individual security risk or unsystematic risk. And here, information ratio is higher for portfolio P, which means manager in portfolio P is better at picking individual securities, and the unsystematic risk can be converted into excess return. So when you look at this big table, you might feel a little confused, right? I mean, for certain measures, it looks like a Q beats P, but for others, P beats Q. So what can we say about the relative performance between P and Q? Well, we have multiple methods in terms of performance evaluation, but certain measure would be better under certain circumstances. Right? And if we consider diversified portfolio, then alpha could be a better measure of performance than the Sharpe ratio at a certain time. We might say trend measure is better than M square, or so on and so forth. So it's really depend on the situation that the money managers are facing, depend on the structure of their portfolio and their investment styles. Now, let's take a look at some detailed information about those individual risk-return trade-off measures. The first one is Sharpe ratio. And once again, Sharpe ratio is also called reward to volatility ratio. And here's the equation. Sharpe ratio equals access return divided by standard deviation. So that is reward to total risk that a portfolio manager bears in their portfolio. And the standard deviation contains both market risk and unsystematic risk. So Sharpe ratio is frequently used when choosing among competing portfolios that would not be mixed. Right? And those portfolios tend to be not well diversified, so that unsystematic risk should be considered in the performance evaluation. And the second measure is M square. M square is the return difference between managed portfolio leverage to match volatility of passive index and return on that index. Essentially is the return difference between individual portfolio and a benchmark portfolio. And I think this M square measure is pretty good for any passively managed portfolio. Why is that? Because the goal for passively managed portfolio is to closely track the market index performance, and this M square should be as small as possible. But if you found large amount of M square, that means there's a large amount of tracking errors in that passively managed portfolio. But for actively managed portfolio, it's a totally different story. Trend measure equals ratio of portfolio access return to beta. And this is very similar to Sharpe ratio, right? Sharpe ratio is ratio of access return to standard deviation. But here it's been changed to beta. And I think the difference here is beta measures the market risk, and the standard deviation measures total risk, which contains both market risk and individual firm risk. And typically speaking, for a well-diversified portfolio, we would assume that unsystematic risk would equal to 0. What's left here is the market risk, and this trend measure take consideration of this type of diversified portfolio. And the risk-return trade-off is the risk-return trade-off between access return and market risk of the portfolio. And the trend measure is a great measure, often used by manager to evaluate a portfolio that is part of a larger portfolio with different managers. With a larger portfolio, which managed by many different managers, you would imagine that portfolio tend to be more diversified. And in that case, the only thing that we need to worry about is the market risk, which can be captured by the beta in this trend measure. And fourth very useful measure for risk-return trade-off is so-called information ratio. And information ratio take consideration of non-diversifiable risk. Diversifiable risk, which is individual companies' risk. Take a look at the ratio of alpha to the standard deviation of diversifiable risk. Right? And the information ratio is very important for portfolio that is not well diversified. And the manager intentionally take risk in certain individual securities. In that case, the unsystematic risk cannot be diversified away, and by bearing the unsystematic risk, manager hope to beat the market by bearing that actual amount of risk. So here, the ratio of alpha to the standard deviation of diversifiable risk shows how good individual money manager pick those individual securities. And we call this as information ratio. And the last one is a very, very popular measure for performance evaluation, that is called Jensen's alpha. So what is Jensen's alpha? Alpha here is the access return. Remember, there are many definitions for access return. You can say access return equal to real return minus risk-free rate, right? That is one definition of access return. And here, alpha is The excess return not relative to risk-free asset, but relative to what a manager is supposed to deliver based on the beta, based on the market risk built in his or her portfolio. So alpha is the difference between actual rate of return and the expected rate of return given the level of risk in that portfolio. And once again, we assume that the portfolio is well diversified, and only risk that we need to consider is the market risk, which can be captured by beta. So this alpha equals actual rate of return minus expected rate of return. Expected rate of return equals beta times market excess return or market premium. And this alpha is a very typical measure for abnormal return. And alpha is one of the best things on Wall Street. And any investor can generate consistent, significant amount of alpha, will simply be the great money manager for their clients. And alpha can be transported, can be captured, or can be hedged by using financial instruments. And we already learned about the technique in the previous chapters. And we call this as portable alpha strategy or pure play strategy. And here is another example showing you how alpha can be transported or reserved or make it portable based on a arbitrage portfolio. So here investor has portfolio, and this portfolio has exposure not only to the market risk but also healthcare sector risk. So in order to make this arbitrage portfolio, we want to fit out both the sector risk, the healthcare sector risk, as well as the market risk. And practically what we need to do is take short position on both market index futures as well as the healthcare sector futures index. Healthcare sector index futures contract. Right? Once we take short position on those two futures contracts, then the risk can be neutralized. And once we add position on risk-free assets, either a long position, short position, we get a so-called arbitrage portfolio Z, and this Z only generate alpha. So this is one example on how to capture alpha. It is tradition that we utilize CAPM model to generate alpha, and we assume there's only one factor determining stock return, which is beta. But as we know, in most recent years, it become a new standard for Wall Street professionals. Not only use CAPM model, but use from French 3-factor models to find expected rate of return. So nowadays, it's more common for people to utilize the 3-factor models, from a French 3-factor models, which contains not only beta but also small company effect as well as value company effect into the equation to estimate expected rate of return. Right? Then the difference between real return and expected return is the alpha. At a certain time, we want to look at a certain mutual fund or hedge fund to see what they are doing, right? Because they may not be able to tell you what they are doing, but we can figure out what they are doing by analyzing their return data. And actually, this is so-called style analysis. Style analysis is more valuable when we analyze hedge funds' performance. And here is the table showing you how we do style analysis for a typical hedge fund. And let's say this hedge fund generates certain amount of return during the last 5-10 years. Then you have a series of return data. Then you found other series such as intermediate term bond return data, long-term bond return, corporate bond return, so on and so forth. And also you found the data for growth stocks, medium cap stocks, small stocks, so on and so forth. And then you run regression between hedge funds return versus those different asset class returns, time series, and the regression will generate coefficient. And here the regression generate regression generate 47 coefficient on growth stocks, 31 on mid cap stock, and 18 on small stock. And 4 on the European stock, and that means this company is not a bond-oriented fund because coefficients are 0. It looks like the return has nothing to do with the bond market performance, but it has very close relationship with stock market performance. And actually, this fund have very significant relation with growth stocks performance, mid cap, small cap stocks, and a little bit international investment associated with the European market. So at this point, you can say that, okay, this fund, although you the fund manager didn't tell you what they are doing, but from their return data, you can say, okay, this fund focused on both medium cap and small stocks, and they choose those stocks with high growth opportunities, and they also have a little exposure on the European stock market. So that's what they are doing based on this style analysis. For passively managed fund, and here you don't need to pay a lot of attention to alpha or other risk-return trade-off measures, because for passively managed fund, their goal is to track the market index. And a good manager versus the bad manager in passive investment strategy will be reflecting the tracking error. So the best manager will be defined as a manager who can closely mimic the market return, which makes tracking error as small as possible. As you see, this table showed you the average tracking error among more than 300 mutual funds. And most of those mutual funds have a low number for tracking error, which is close to 0. And on the both ends, you see, okay, tracking error can be as high as 30-50% or even 100%, but most mutual funds tend to have small tracking error, and ideally tracking error should be close to 0. That means you're doing a good job as passively managed fund. So performance evaluation is not easy work. It's not just about return, and sometimes you have conflicting conclusions you can draw based on different measures. And here, there are a lot of problems, limitations associated with the performance evaluation. Right? And often we assume that certain fund will maintain constant level of risk, right? But actually, that is not a valid assumption, because managers often will rebalance their portfolio. They will change their asset allocation decision or individual security selection, and the level of risk in their portfolio is a changing number. And in a large universal fund, some will have abnormal performance each period by chance, which means, okay, some people are seemingly delivering a very nice risk-return trade-off, but you don't know if this is caused by their true capability or simply by luck. Right? And so for performance evaluation, it's better to do a little bit long-term analysis to see how consistent abnormal performance lasts for certain managers or for certain funds. And another problem that investors need to pay attention to is survivorship bias. Because for those funds that all underperformed the market or failed over time, they are kicked off from your data, and that may overestimate the average risk return trade-off in the investment universe. Okay, so we in this video, we already introduced many different measure of risk return trade-off, and also we address some limitations, problems associated with performance evaluation. I think the most important thing that you need to know is performance evaluation is not all about risk, it's not all about returns. It's about risk return trade-offs. And performance evaluation is very useful for money managers to show their clients how well they are doing their money managing business. But another important aspect for performance evaluation is that every time when manager spend a lot of time measuring risk return trade-off of their portfolio, and actually the performance evaluation process itself can deliver very valuable stuff for the manager. And at a certain time, performance evaluation can tell manager where is the weakness, where is the strength of their portfolio, and in the future how to improve risk return trade-off based on the analyzing results from a certain performance evaluation. And in the next video, we will introduce so-called performance attribution analysis, so we can identify where is the weakness, where is the strength of money managers' business, and how we can improve risk return trade-off in the future based on this performance attribution analysis. Now let's take a short break.